Hey everybody, Dave Huber here with TRADEway, and it is time to talk about what's hot in the market. I see people just kind of starting to filter in here. Got Coach Blair Nightingale on with me. Hey Blair, how are you
Good
this morning?
morning.
We're going
Good
to talk
morning,
about
everybody.
we're talking about what's hot in the market. And if you've been following the market, you know nothing is hot in the market. Like it is all just crashing. Like it might be on fire, right? Like maybe that's what we mean by hot in the market. It's on fire. Um, no, so there's a lot of opportunity that's about to present itself here, but also Blair, like there's this crash that we're seeing. We talked about this in our challenge a couple of weeks ago, how everything is pointing towards a crash. Like we should be getting a crash soon, a recession, the inverted yield curve, inverted again. It's ridiculous. And we're going, all right, so what do we do? Like, this is something that is truly terrifying for a lot of people that don't know what they don't know. And so, what we're going to do today is we're going to help you make sense of what's going on, why it's happening, but also what can we do so that it's not so scary. Because if you've got retirement invested in the stock market right now, you're probably thinking, "Ugh, I'm losing big time," and there's no bottom in sight just yet. So, like, is it going to get worse? Maybe so. So, Blair, let's talk about this a little bit. What's going on in this market? Why is it crashing?
Yeah. I mean, what's amazing, Dave, is that I actually forgot. This is true. I actually forgot that during our challenge, we did, for those of you that don't know, we do a 5-day challenge where we give you the 5 crucial foundational things that we believe, having coached thousands of traders all over the country, we believe you need, right? We need to be able to know what they are, because most of us think trading is something that trading is not, right? If you think it's guessing, gambling, or going for it, then the first thing we need to do is learn what trading actually is. Wall Street has skills to manage money. Um, they don't ride these crashes to the bottom. Okay, maybe more on that later, Dave. But my point is, in the challenge that we were doing, Dave and I have a section in there where we just show some data. I'd like to use a better term than that, but that's really what it was. That tells us where's the economy at, right? You go to a doctor, they run a bunch of tests, they give you data, right? Let's check the heart, let's check the blood pressure, let's check whatever the test is. Well, we do that kind of thing on the economy as well, because the stock market and the economy are really closely tied, right? If there's a lot of confidence, then the stock market's probably going to go up, because people are going to say, Wall Street is going to say, wow, these companies are making good money. I'm going to keep investing. I'm going to put my money in the stock market, says the big money on Wall Street. And that, of course, makes it go up further. When they lose confidence, they start taking their money out. They put it elsewhere. There's other places they can put their money, and it goes down. So that is what is happening. Okay. Now, when we were in the challenge, we told the students that there is an indicator, there's a test, right? Like I said, the doctor's office. And we don't need to know exactly what it is here for time's sake, Dave, and it's not important to explain all the ins and outs, but it's what we call a yield curve. Okay. There are these debt instruments, debt that people like to buy. There's really long-term debt and short-term. Okay. And typically you get paid more for the long term because it's long, right? If you take on debt for a longer period of time, Wall Street will pay you a little extra money. The point is, those two reversed, they flipped. You're making more on the one that you wouldn't think you'd make more on. You're making less on the one you think you'd make. And what it tells us is the long-term confidence has plummeted. The short-term interest has skyrocketed. Why? Because Wall Street's afraid. They're afraid of the long term. What does that do? It says, hold on a second. All the richest people in the world are saying, we don't feel so good about the future right now. Not as much as we did. And so those flipped. That's what we call an inversion. And it happened in the challenge. Now, here's the cool thing, Dave. Almost every time in American history, with I think one exception, it has always predicted a recession. Now, if you get to know Dave and I or us here at TRADEway, you'll know that we don't like to predict because trading isn't about predicting. You don't need to predict, okay? But this is a check engine light, if you will, on the dashboard. And with almost 100% accuracy, it has predicted a recession. Now, what's very interesting about this, Dave, when you bring that up, I said, I forgot. We told our students on the challenge, hey,
Yeah.
this just triggered today. It was in the
Yeah.
news. You can look it up the last time. Yield curve inversion, right? That thing I've been saying. We said, hey, guys, this just happened again today. So we're talking about getting ready. Now, that was what, 2.5 weeks ago here, Dave. And the
Or
market
this
is down.
crash.
The market's down 9.6%. Now, just because that inversion happens doesn't mean the market has to crash like the next day, okay? That doesn't necessarily have to happen. But in this case, it flashed the warning sign, and the market's down almost 10%. Now, the NASDAQ's down over 10%. So the tech index, if you want to call it that, is down about 14%. Whereas the S&P 500, which is a little bit more broad-based, it's got a little bit more of a mixed basket of eggs.
A little more diversification, right?
Yeah, exactly. That's down about 9.6% as of this morning. Now, the market's only been open for 2.5 hours. So when I say this morning, I mean today, now, right? So there are things that we can know. Do they predict? No, right? When the gas tank's on empty, do I know exactly the moment I'm going to run out of gas and roll off to the side of the road? Maybe not. But when it's sitting on zero, okay, it's time to do something about it, right?
Right.
So we may not know the exact moment, but we don't need to. Now, the last thing I'll say here, Dave, some of us, we don't know how to read those gauges. That's the problem. That's where the fear comes.
Very true.
We don't know how. So Blair, thanks for the analogy. Looking on the dashboard, check engine light, running out of gas. Okay, when I'm sitting in my car, I know how to do that. That's pretty simple. There's gauges and I read them and then I'm able to make good decisions, right? I don't want to drive off to the side of the road with no gas. So I read the gauges and I manage risk accordingly, right? I don't let the tank get empty. But that doesn't help me when I'm looking at the stock market because I don't know how to read the gauges, right? Well, that's what we help people do, guys. We help you know what are some things, some tools, some skills that you can learn. You don't need to be employed on Wall Street, okay?
Sure.
This is what TRADEway is all about. So, Dave, as the market is moving down, what should we be thinking? We know how people are feeling. Dave said it already, right? People are nervous at best.
Yeah.
And the tariff news, by the way, which is driving a lot of this uncertainty, it's not going to slow down, I don't think. I don't see any reason to support that at this point in time.
No, you're gonna keep seeing tariff news because the administration is using tariffs for a purpose. They have a mission. They've not accomplished their mission yet, but they're going to continue using the tariffs until they do. And it's going to create, to some degree, some trade wars. We're already seeing signs of that. Canada saying, we're going to keep our tariffs in place until we get respect and stuff like that. Well, here's the reality. You basically have a bunch of economies that are like giant customers. And America is the biggest customer of all. And when you impose a tariff, here's what you do. You make it harder to sell to the customer. So we impose a tariff. It is now harder to sell to America. You will go, well, that doesn't sound good. Why would that be good? The reason why is when we do that, it makes it so that outside countries, they end up having to work harder to sell to us, and their products go up in price, which of course the companies pass along to us, the consumers, and we go, well, see, tariffs are bad. But then we have the opportunity to say, yeah, but I'm going to stop buying that company's product and I'm going to go to this other company. And we can go and start buying things made in America. And when we do that, what we're doing is we're passing the tariff tax back to the foreign company, to the foreign country. So when we do this, here's what happens. We make it so that we can have our workers like start to get more jobs. We can start new companies. It's kind of a long game. It takes some time because now you've got new companies coming on board. You've got new workers coming on board. So it's going to take some time for this mission to be accomplished. It's not like you just impose a tax and everybody goes, okay, we give up and we're done. It doesn't work that way. Like, we're doing this until we start getting our American workers back to work. So it is here to stay. But what does that mean for you? What about my retirement, Blair? Like, retirement just got hit. You just told me by 9%, perhaps. And that's if I'm just invested in a very diversified portfolio represented by the S&P 500. If I was tech heavy, I may be down as much as 14%.
Maybe more.
Maybe
How
more.
many of us have heard of Nvidia?
Oh, yeah.
Right?
NVIDIA was down more than that, wasn't it?
Nvidia, as of yesterday, was down 30%.
Ooh,
So
wow.
if we were of the mind that we want to hold some of these big market leaders, the S&P 500, okay, that's 500 stocks in the basket, right? There are 7 stocks, 7 of the 500 that are responsible for almost the majority. In fact, in some cases, it is the majority of the growth of the S&P 500. So if you owned some of those strongest stocks, you would theoretically, if you owned that basket, you'd be down way more than 9.6% right now.
Which
So
is
everybody
often
might
the
be in a bit of a
case.
different spot here.
That's often the case with retirement accounts. And so here's what the world is going to do to you guys. And by the way, let us know where you're listening from here in the chat. I want to make sure that we got everybody like tuned in, listening up, because Blair and I are about to tell you, what do we do about this? Like, how do we make sure that we are not just finding ourselves getting decimated in our retirement accounts? Got some from Georgia. Welcome. Illinois. Very good. All right. We got people from all over the country coming in. Blair, here's the thing. There we go. Got some slower typers there. All right. South Carolina, Arizona, SoCal. Here's the thing. The world is going to tell you guys this is terrible. And to some degree, it is. But all you're going to see in the news are scare tactics to keep you away from the stock market. And this is what the world and the financial system uses to make you go, yeah, this is just a dangerous place to put my money. Like, I just need to give my money to the professionals and let them take care of it. But here's what happens. Giving your money to the professionals is what you do in your retirements. And if you're seeing your retirement go down these last week and a half, 2 weeks, it's because they're invested in the market. And while they're telling you, hold on, what are the big boys on Wall Street doing, Blair? They're telling us, hold on, you're in for the long haul. And it feels like I'm more in for the long fall. So what are the
Yeah.
big boys doing there?
Well, the thing is, and I'll say this, okay, 2 things. One, when the market is dropping, okay, is that Main Street, Tom, Dick, and Jane, as you will, if you will, selling their stocks? Well, no. First of all, Tom, Dick, and Jane typically aren't doing any management at all. So they're not probably selling their stocks based on that, right? I'm just talking about everyday folks, right?
Yep.
They are trusting Wall Street to do whatever it is Wall Street does. Most of us are like, I'm not even really sure. That's why they do what they do. And so then I just can do what I do. And that mixture is fear and passivity and loss and all those kinds of things. So we are looking at it like, well, is it just Americans selling? By and large, Dave, no, it's the big money, billions and billions and billions moving the stock market, these kinds of numbers, these huge numbers, okay? So Wall Street are the ones selling. Well, how do we know that? Because the market is moving down. It doesn't move down if they don't sell. So just ask yourself, don't take my word for it. Ask yourself, why are they telling me to hold? Why am I supposed to just watch and wait and throw
And
that
hope and
prospectus
pray.
into the drawer, as it were? Prospectus, what is that? Your statement. You know what? Just don't even look at the statement for a year. We're going through a rough ride here. That's what managers will say. Okay. But Wall Street's not doing that. Wall Street says, no, time to put our money somewhere better. And they pull it out, which means they sell. Now, when they sell, it drops. You're supposed to take it, what? To the bottom. Just wait
Yep.
it out. It'll come back. When? When Wall Street, who takes their money elsewhere, safer havens, if you will, begins to feel more confident about the economy and they move their money back in. So they take it out early. You see the drop. Then when they decide, when they feel like it, they put it back in. This is billions and billions pumped back in. Then you see a recovery. So now you're just trying to get back maybe to break even, and they're buying low, selling high.
And while you're being told, hold on for the long haul, and you have to endure the long fall, now you've wasted time. All that time that it took to build that retirement up to where it is. Blair likes to say that the S&P likes to take the stairs up and the elevator down. And look at how true that is. Like, it took some time to build up as high as we are or were. And
Right.
now the elevator has just taken us right back down. So we've wasted a lot of time. And so what happens is, if you're still holding on to your retirement accounts right now and you're just paralyzed, not knowing what to do, you're going, man, how long is it going to take for me to recover from that? Because it's not going to take the elevator back up. It's going to take the stairs back up. And, when we had a full-blown recession back in the year 2000, it took 13 years to recover the losses from that recession. 13 years. In '08, it took a few years there too. It's not like it just came right back. It took years. And so while you are paying years of your time, they're collecting. And it's like this secret way to just take money out of the pockets of Americans, and they don't even realize that's what's happening. Like, you tell them hold on for the long haul. What you really mean is hold on for the long fall. And they get it. They take it in the rear, and then you, as a big boy, get to come out and just rake in the dough. And so, guys, what do? How do we avoid this? Because we just didn't know what we didn't know. So, Blair, let's tell them something we can do. Step one, like, how do we stop the bleeding? Well, there are a couple of ways you can stop the bleeding. Why don't we pull up a chart real quick, Blair, and let them see where the market is so that we can decide if we need to stop the bleeding.
Yeah, totally.
But one of the first things you can do to stop the bleeding in something like a retirement account is you can have a discussion with your financial advisor, and you can say, hey, I think I want to go to cash. Sometimes you don't have that option. You can do what's called near cash or a money market account. You can tell them, hey, I want to go low to no risk. Sometimes that's the terminology they use, right? Low to no risk. And what that does is it pulls the money that's currently invested in your stocks. It pulls it out and puts it into either a money market account or like a savings type account. It's still in your retirement. It's not like you're going to to pay taxes or penalties when you do this. It just gets it away from the stocks that are crashing, and it keeps it in that retirement account, but in more like a cash position, which, by the way, cash is what we call a position in stock trading. It's one of the most important trades you'll learn to do is going to cash. And so you can stop the bleeding just that way. But I mean, at this point, if you haven't already stopped the bleeding, you've almost bled out to some degree, right? Like we've lost an appendage here, 8, 9%. And if we're tech heavy, 14 or more percent, that's a big drop there, Blair. We call 10% correction territory. If we get down to 20%, it's recessionary territory.
Yep.
So where are we right now, Blair? What is it looking like?
Yeah, so here's the thing. If I go, well, okay, let's do this first. So I know I've got some stuff drawn on here you may or may not be familiar with. The first thing I wanted you guys to notice was this, okay, here, because Dave said, what are some things we can start to look at, okay? Now we mentioned, I'm going to give us a little bit of space on the right side here. We mentioned the yield curve. So let me give you a couple of things that for the rest of your life, you're going to want to pay some attention to these things. Okay, here's the first one. Interest rates. We're not going to talk at length today about interest rates. It's kind of taken a little bit of a backseat to the tariff news. The tariff news is the main thing that Wall Street is focused on. Interest rates has been the main thing. You don't need to know all the ins and outs of interest rates, okay? I don't know. I've learned a lot. I don't know all the ins and outs, okay? But I know that the government, essentially, the Federal Reserve, is going to raise or lower what we call the benchmark interest rate, okay? Or the federal funds rate. Again, we don't need to remember all the titles, but this is what basically tells our country what interest rates on just about everything should be. If they're going up, Wall Street cares. If they're going down, Wall Street cares. Now, Wall Street likes it when they're going down. That's cheap money. They like that. So for the rest of your life, if interest rates are going up, it's probably going to put pressure on the stock market. If interest rates are going down, it's probably going to be something the stock market likes. Okay? That's the first thing. When interest rate policy changes direction, oh, it's been going up and now it's started going down. It's been going down or it stayed down and now it's starting to go up. 2022, by the way, the market went down over 20%. That's a bear market. Why? They started raising interest rates. Okay. We're not predicting. We understand some of the things on the dashboard. That's the first one. The second one is you're looking at this chart, right? Now we don't need to go super, super deep on this right now. Blair, what are those lines, all that? Don't worry about that so much right now. What I want you to recognize is it's going that direction, bottom left to top right. That's the overall direction of the market. Okay. We're just talking big picture here. Is there some really cool stuff that you and I can learn to do in these moves up and down? Absolutely. Right now, we're looking at the big picture. It was going up. Now it's not hard to see at some point here, it started doing that. That's why I've got this box drawn on here for you. It stopped advancing and it flattened out. And then eventually it broke down through that box. It tried to get above it here, couldn't. Tried there, couldn't. Tried again, couldn't. Tried, we thought maybe it would, and it couldn't. When it keeps hitting the ceiling over and over, sideways, did we know it was going to crash? No. Does that say, oh, check engine light? Yes, it does.
And going back to what you started off saying, Blair, what does that mean? Well, if the stock market's going up, that means Wall Street is buying. If it's going down, it means they're selling. So if it has been going up and then it stops going up, maybe it's not going down yet, maybe it's stuck going sideways, that gives you your first big warning sign, because now Wall Street is not buying as much. If they buy less and less and less, what might they start doing? they might start selling more and more and more. So your first big warning sign of what just happened was that it stopped going bottom left to top right. It stopped moving up. It got stuck. And when it gets stuck, that means that they are starting to shift their thinking towards selling. And sure enough, we got some heavy selling going on right now.
When you guys were little, you learned to read. Simple as that. You learned to read. You didn't know how, and then you worked on it, and then you knew how, right?
Yep.
And you did so when you were very little. You were just learning to learn. Okay? So when we are looking at our finances, looking at the chart that I have on the screen right now, you're going to learn how to read this chart. Okay? It's not a crystal ball. We don't need to predict, but we can look at it and it tells us a lot of really important information. It really does. Now, we've given you a high level view, something very, very simple. Hey, it's advancing, right? It's moving up. That's what we like on a line graph, right? We want it going up as far as growth is concerned. And then it stopped going up and it started going sideways before it started going down. And usually markets don't go, hard diagonal and then immediately diagonal down. They usually cool off and then they roll over, we like to say. So you're going to learn to read a chart. The more you learn, right? There is a learnable skill in investing. It is a learnable skill. I just told you, chart moving up, moving sideways, warning light. If you didn't know that, now you do. That's not subjective. Guessing tomorrow is subjective. Looking at the chart and seeing things slow down can be very objective. Interest rates moving up or down, not subjective. Guessing what's going to happen tomorrow based on that, sure, there's some subjectivity there, of course. But by and large, looking at interest rates, we also talked about the yield curve, okay? Yield curve. We're talking big picture here, guys. This is your retirement money or any savings you have, or just understanding the economy in general, because no politician can avoid recessions forever. We like to think that we could vote the right person in. They would all be able to do that. And interestingly enough, there are some politicians that are willing to print unbelievable amounts of money in order to prop up economies and markets. But in the end, we got to pay the piper even when we do that. That's a conversation for another time. But there's a reason the markets have been as strong as they have. And eventually they will go into recessions. This has always happened and it always will to a degree, right?
And we're actually repeating history here, because if you look back at Reagan's administration right after Jimmy Carter, the exact same thing was happening. We had high interest rates, high inflation. We actually tried to cut rates too soon. We got a double dip recession right at the beginning of Reagan's term. And he did the things to kind of let the cows come home, right? And pay the piper, as you say, right? He did the things that needed to be done to make our economy healthy again, but that means going through a hard time. Now, wealth is never destroyed in a recession. It just changes hands. That's what we were talking about earlier. Like, you're told, hold on for the long haul so that it can change away from your hands to somebody else's hands. You don't have to stay in that position. If you just know a few things, like how to stop the bleeding, go into cash, go into low to no risk, near cash money market accounts, that kind of thing. If you just know that, you can at least stop the bleeding. But then you're sitting in cash, which, since we still have high inflation, that gets eaten away as well. So it slows the bleeding, I should say. Blair, is there something we can do so that we don't waste a whole bunch of time sitting in cash and letting inflation kill us? Is there something that we can learn to do so that the money can flow in instead of flowing out during this time?
Right. Yeah. So, and we've had students even let us know in recent weeks that that's one of the things they've been doing is moving to cash. Now, you need a certain level of confidence right? We're probably not going to make decisions without confidence. So one of the things that we do, this is what Dave and I do. We help you know how to pull these pieces together so that you have confidence. Because when you're confident, then you can be decisive in what you do, right? Otherwise, we can kind of feel frozen and we're not really sure what to do. And we just watch things play out. And that tends to create anxiety and usually that leads to loss. So we want to have confidence. So cash is one thing, but yes, Dave, like 9.6% down. What are some things that people on Wall Street can do, right? Well, the good news is it doesn't just have to be people on Wall Street, because now you and I, with a brokerage account and charts like I'm looking at right now, can go and do some things where we don't have to be on Wall Street, because Wall Street comes to us in a way. And I say that and it sounds kind of like it's just a fact. We have access to the things that they built for them, so we can use it for ourselves. One of those things is what we call put options. Now, who's heard of a put option on here?
Put in
Okay.
the chat if you've heard of a put
Okay, if you've never
option.
heard of it. Some of you guys have been around us a little bit, so I think you probably have heard of them. Okay. Yeah, Steve and Egbert, you guys were with us
On the
already.
challenge, so you
Okay.
know a little bit about them. Yep.
Yep. Okay. So a few people, most of us maybe not.
Mm-hmm.
Okay, most of us maybe not. Kathleen, put options. Okay, this is going to be level 1 instruction on put options. Okay, there's
Mm-hmm.
more we can understand later, but for now, here's what I want us to all just accept. Okay, we're going to accept this. Put options are something you can buy. You could say an instrument, right? We can buy it in our brokerage account. Instead of buying a stock, we could buy this put option contract. It doesn't come in shares, it comes in contracts. It's a little bit different, okay? You say, I never heard of this. Most people haven't. This isn't a huge secret, right? Most people don't know most of the most basic things about the market. So it shouldn't be too surprising to us, even if it is a little upsetting, okay, that we've never heard of it. So
Well, and
put
what do we like to call it, Blair? Because this is what really kind of makes it upsetting. What do we like to call these put options?
well, I sometimes like to stir the pot a little bit and call it retirement insurance.
Mhm.
Now, the truth is this can be insurance against your stock ownership, right? When we own a home, a car, a phone, even your own life, you can buy insurance. It hedges the risk, right? Whatever the risk is for that asset, your life, your home, if something happens, it hedges it. It covers the damage. It covers the loss. Well, you think Wall Street's never come up with a way to do that for themselves when it comes to stock? Like, is it totally beyond them to go, I'm going to make something up that if the market crashes, I get paid? Of course they have. It's called a put option.
Mhm.
Okay. And what it does, and this is level 1 understanding, it makes money when the stock market goes down. Period. That's it. Level 1 understanding. Blair, why? How? Don't worry about that yet. Doesn't matter right now. They made it for themselves. And when the market moves down, it makes money. So you're losing money on your shares, but you're making money on the insurance. Your car is damaged. Ooh, it's worth less. But your contract that you have with your car insurance provider, they're going to cover that damage and it's made whole.
Blair, have you
That's
ever noticed how when you go and buy a car, they don't sit there and tell you to get insurance? You know, like you have to remember to do that. You can drive the car off the lot and not have insurance on it. The car
totally.
company doesn't just, but also like house. No, I remember when I bought my house, I had to get insurance. Yeah, that's because you had a mortgage and the bank is tied to the house. So they want insurance to protect themselves. The house builder does not tell you, hey, go out and get your insurance, right? And it's the same thing with the stock market. The stock market's not going to tell you go out and get the insurance. But the people who know that there is an element of risk involved with the stock market, they know I want to go out and get this insurance stuff. You haven't been told about it, and you've been sitting in a retirement account that's invested in the stock market, and your financial advisor who's supposed to be taking care of you failed to mention, oh, by the way, you need retirement insurance. He wouldn't call it that, of course, but he might talk about these put options because they were literally created to be insurance. That's why they exist. That's why the Wall Street made it for themselves so that they would have a form of insurance against their stock assets. So now we have this thing, right? We own stocks in our retirement accounts. We buy stocks. Maybe we got all excited about the stock market when we saw a lot of people were making money in it. So we opened a Robinhood account or an E-Trade account. We said, I'm going to go buy some stocks. And at the same time, you didn't realize that you could also have the opportunity to buy insurance on those stocks. And so we go and we look at the stock market and we go, oh, it's so scary. It's so crazy. But there's actually a way to protect yourself. And that's what Blair's talking about. So Blair, what do we do? Like, what is a put option and how does it work for us?
Well, let's see what a put option could do here. So we'll use the high we hit here. Okay, now I'll say we're going to use this to see what a put option can do. Okay, we go out and purchase the insurance. Okay, we may not purchase that insurance at the exact high of the market. Okay, now it just so happens today is the low. We're continuing to move down. This is the lowest we've been in a long time. And of this slide downward, we have not bounced back up yet. So today is the day I'm also going to use in the projection here. But I'm going to start this green candle right here at the top. That's February 19th. And we're just going to say, all right, if I owned put options through that time, okay, the check engine lights came on. Maybe you didn't buy it on this day. Maybe you bought it a little further back, but I'm going to show you from here just through that slide so you can see what that kind of a move can do when it comes to put options. So I'm going to use my software here and I'm going to go into options. Okay, we don't need to understand all this stuff right here because I've already popped all the data in. Okay, I've gone from that date down to today's date. So I can just tell the software, hey, I'm going to buy this option. Tell me what happens from this date to this date. That's all we want to know, okay? If you owned 100 shares, essentially, of the S&P 500, in this case, we're using a stock that tracks with the S&P 500. It's called the SPY or the SPY, okay? It's one of the most popular stocks on the planet Earth because it follows the American economy through the S&P 500. You can't buy and sell the S&P 500, but you can buy this other stock product called an ETF that tracks with it. You say, Blair, that's a lot of weird little terms. Okay, just know, here's the market, S&P 500. Here's the stock that tracks with it. Okay, it's a correlated instrument. So if I owned 100 shares of that, I've lost that almost 10%, 9.6%. So if I just own the stock and it dropped, boom, 10%, that's what I lost. Now, if we go into a bear market, which happened in 2022, it can happen. That's going to be double that, right? So we're not just talking about the 9.6. Maybe it bounces up from here, and we probably will get some what we call snapbacks. It shoots up. People get confident again, they jump in, they buy, and Wall Street dumps the market again, right? So we don't want to just go think that one green day up is the end of the drop, okay? A lot of people get faked out by that. So that's something where our coaches are really helping our students day to day understand how to do that. I digress. Point being, 9.6% down if you just own the stock. And what if we get another 10% down? Okay. We've had recessions in the past where it was 30. Right? What's that?
I said, well, that's entirely possible too. Just looking at the chart, we don't have what we would call a technical reason to believe that this is going to just bounce right back up yet. It could, But
Yeah,
it
we
could also
don't.
continue down.
We could easily continue down for two reasons. One, it's not at a significant level, right? There's not a significant floor where we're at right now. As it gets cheaper and cheaper, it might raise some desire for a little bit of buying, but that doesn't give us anything objective to go on. So we're still without a floor. It's just falling. Second reason is the tariff news just continues to roll out. As long as there's uncertainty there and it just keeps coming in these Truth Social tweets, we're going to see that volatility. So you and I don't have to know. This is what you need to know today. You don't have to know how to sort all that out. Two things are present. Number one, there are instruments that you can use. You don't know exactly what's going to happen with every other driver on the road when you're out there driving your car. So you say, I'm good. I mean, nobody wants to get in a wreck, right? Certainly nobody wants, I live in California, nobody wants to lose their home in fires, okay? But you've got the peace of mind when you need it. You know what to do. That's the first thing. The second thing is Dave and I, our whole team, we're here to help people. We help people. Dave, I've had somebody call me. This was in COVID. So this is 5 years ago now, almost to the, well, this phone call wasn't to the day, but COVID lockdown was almost 5 years to the day. This student got on the phone with me. She said, Blair, I don't know what I'm going to do. My account is cut in half of what I have. Right? Does this happen to everybody? No, not necessarily. Depends on your situation. I'm just saying, Dave, we're on here today, and I honestly feel like we've got 24 people on here. There should be 250. There should be 1,200 people on this webinar because I get these phone calls and it ends up being too little too late, right? Where what you've worked for is now it gets rocked. So what we're talking about here is helping you know what to do. That's what we are doing here. Okay. There's a
Well, and you
reason
know,
why we do what we do.
it's not even just an anomaly. I mean, yeah, that sounds extreme. 50%, half? Are you serious? That actually happens? Like, that's my dad's story, Blair, if you remember Pop. Like,
Yeah.
he watched his retirement account get cut in half in 2000 and then get cut in half again in 2008. What were
Yeah.
those? Those were recessions. What are we flirting with right here? We're flirting with a potential recession. And
Yeah.
so it's very real. It's a very real and present danger.
Yeah. And guys, we talk about this, recessions happen. They happen. Okay. But also corrections happen. So a recession is 20% or more. A correction typically is defined 10%, which we're, like I said, 76% of S&P 500 stocks right now are already in a correction. They're more than 10% down. Many more in the NASDAQ. The NASDAQ itself as an index is below 10%. It's at 14% down. Okay. Many tech stocks in 2022 got cut in half. Many of them. Go back, look at a chart. All right. Don't take my word for it. You can look at it. Point being, things are dropping. Could they keep going? Of course. Okay. What if they don't? What if they turn around? What if they start shooting higher? Well, that's just great opportunity.
Yep.
Now, we need some confirmation for that to happen. We teach you how to do that. But whether things drop more, scenario number one, right? And we are or aren't protected, that can happen. Which camp do you want to be in? What are you
Yep.
going to do if you don't protect yourself? What's the plan? What are you going to do for your money if you don't protect yourself? Scenario number one. Number two, it goes down, then we get a great bull market opportunity. Now, there's two camps. The ones that got ripped on the downside, and they're just trying to get back to where they were. By the way, if you have $10 and you lose 50%, you lose $5. Now, how much do you need to make to get back to where you were? 100%. People say, no, in 50%, Blair, I only lost 50%. I got to make 50% back. No, if you had 10 and now you have 5, 5 doubled is 10. That's 100% you need to get back just to where you were. So if you get ripped on the downside, well, everybody else is going Wall Street, let's say that. They're taking advantage of a nice, fresh, hot bull market. Two things are true. One, they have more capital for that. Two, they have skills to take advantage. You can always get ready for
And
what's coming.
that's the thing. People say, well, oh, but the stock market, it seems like such a scary place. It's not as scary as being unprepared. Like so many people are already invested in the stock market, right? They don't even realize it. They're traders.
Yep.
They don't know how to get paid for it. And so you've
Yep.
got so many people in retirement accounts and they go, like your friend, the student, it just got cut in half. What do I do? Well, my dad, that happened to him. Being unprepared is the worst part, right? It's better to go, okay, I don't understand this thing called the stock market, so that makes it a little bit unfamiliar and therefore I'm a little scared of it. It's better to brave that and get educated and learn about it and find out what you didn't know so that you could protect yourself than it is to go, not again. Like if you've lived long enough to go through those past times, you're looking at this and it's like PTSD now, right? Like if you went through 2000, 2008, now it's like, oh my goodness, is this about to happen? You're dreading every tariff tweet you hear because you're like, oh, it's just going to keep going down. Every time he says something, it seems like it's going to crash some more. But you don't have to be scared because what Blair and I say is we don't care what the market's going to do. We just know what we're going to do, right? And so we got a few more things we want to show you guys.
Yeah, totally. It's such a good conversation. So then that's the second scenario.
Before we show them the one, just give you a quick word, guys. Here's what, if you want some help understanding, like, how do I do this? Like, what do I do? How do I get prepared? If you need a plan and you want some help with that plan, I'm going to have Misty put a phone number in the chat for you that you can text. And so in that, you can just text that number and we will help you find a plan for what to do, especially in times like this. All right, so Blair, this isn't just a let's stop the bleeding. This is opportunity. This is why we're excited about this kind of stuff.
It can be. It can be. Yes. Yes. Man, so much good stuff there. You know, I will say this very quickly. The scariest part is right before you get empowered. That's the scariest part. Stepping across that line, it reminds me when we do something new, when we do something different, it feels like risk, right? But when I went bungee jumping, I was doing missions in South Africa in 2008. I went bungee jumping, the highest bungee jump in the world. What was the scariest point of the whole thing? The last second I was on the platform. The least scariest moment was 2 seconds later. This sounds counterintuitive, but once you're engaged, once you're out there, and you say, Blair, I have no interest in doing that kind of thing. That's not my thing. That's fine. That's fine. I'm saying there's an extreme example here where you feel peace and where you feel unsettled is actually the opposite of what most people think. When we stay where we are and we're just like, it's scary, but it's comfortable, so I'm staying. That is the most vulnerable spot we can be in when it comes to protecting our money on Wall Street. So with that said, that's the second scenario. We're not trained as things recover, because as things drop, especially if they do drop deeper, dude, that's some of the best opportunity you can get. Things are so cheap, right?
Yep.
We want to know, so we don't want to burn all our capital. Okay, so what's this crazy screen we're looking at here? Again, we don't need to understand everything on here. We'll take you through all the ins and outs of this when we teach people options, right? Hey, Vish, I'm from South Africa. Yeah, so it was Blauken's Bridge in the Eastern Cape there. It was anyway. So I have a DVD of it. That's how old that was. It was one of the most amazing experiences I've ever had. And I didn't even get out of bed that morning thinking that was going to happen. It just happened. All right. So there you go.
Upgraded from the VHS to the DVD. Is that what
yeah, well, that's true. Yeah. Wow. What an experience, man. It was amazing. So Here's the deal. If we dropped 61.40 to 55.50, right? That's the stock market drop, that high to the low that I was showing you over here on the chart, okay? If I come in here and I buy one insurance contract, okay? This is not the most expensive insurance, all right? It's not the cheapest. We can choose cheaper and more expensive policies, better coverage, lesser coverage. We can do that. Actually, that exists, okay? I've just bought middle of the road here, okay? If I do that, I'm going to make money on the option as the stock drops, okay? So I'm actually going to lose, if I owned 100 shares, I'd lose 5,900 bucks. 5,900 bucks of money, okay? If I had 100 shares. Now that you might have $100,000, you might have 1,000,000, you might have 250, you might have 30,000, whatever your situation is, but just using some easy numbers here, okay? Now, if I had an option with it, you can see over here, my option actually profits me $3,400, $3,410. So as the stock is dropping, the option is making money, 3,400. So if I was going to lose 5,500, now 3,410 of that, I don't lose. I've now cut the loss that I have more than in half. And if the market continues to drop, guess what? This is a cool thing, Dave. The insurance will make even more money for every dollar the market drops, the further down it goes. It actually accelerates its benefit. It's exponential. So the deeper the market drop, the more the insurance will make me. The next $10 of loss, if the market continues down, the insurance will appreciate even more than the last $10. So the deeper it goes, the better the coverage is.
You mean
So
you're
we're looking
rooting
at,
for it to crash at that point?
what's that, Dave?
You're rooting for it to crash at that point?
Well, let's take a look at this, okay? Because Wall Street's done something cool. I can come in here and I have freedom. If I want to buy full coverage, let's think of it that way, okay? Basic coverage, I bought one of these contracts. Blair, I don't really understand the contract thing yet. Remember, I said we're just going to say, all right, we don't know everything yet, but we're just going to look at the numbers. If I bought one contract, okay, these are the numbers. Now let's go, I'm going to look at and let the software tell me, what if I did two? By the way, the profit I made on there, that is in excess of the cost of the option. So I haven't lost the cost, or I haven't lost what I put into the option, right? The premium I pay for an insurance contract, okay? I didn't lose that and then made some money. No, this is that value plus the profit if the market had moved down the way that it has on the chart. If I have two contracts, which is full coverage, I have extra insurance. I had to pay for that, right? I have to pay the premiums, but I've doubled what I've made. So if you look over here on this right-hand side, I now have two put options and my profit is doubled, $7,576 in this drop. Now, how much did I lose on my shares? 5,540. All right. So now I've actually made money.
Money's coming in. It's not flowing out. It's coming in.
I've made about $2,000 on the drop. Now think about
Profit.
that. Everybody else is losing. And in this case, you paid for your insurance and at the low of today, at the very low of today, which right now we're actually literally this moment, we are back at the low of the day. We are at 55.55. So this information is pertinent to right now.
So Blair,
You paid
what if it
$2,000 in a
continues?
stock market crash, a correction.
Yeah.
And same thing is true here, Dave. If the market continues down from here, okay, you will see an acceleration in that profitability. Now, of course, the opposite, if the market begins to move up, if it stabilizes, excuse me, we can go in, sell the insurance back to the market, lock in the profit, and we still own the stock.
Yep. And by the
That's
way,
how
I
it
want
works.
you to take note of what Blair just said. So we talked about like what can we do when the market starts crashing? Well, we definitely had some warning signs that it was going to crash. So if you learn to read the signs and read the chart and see the warning signals, the check engine light, if you will, then you can be prepared for these type of crashes. But then the first thing we said you could do is just go to cash. What does that mean? Sell your stocks. Even in your retirement accounts, which are often invested in stocks, you could sell those. But you go, Dave, what if I didn't want to sell them? What if I really love the stocks I'm in and I want to hold them long term? I want to hold those stocks for the foreseeable future. Doesn't that mean I have to take the hit? And what we're telling you is no, you could either sell the stocks, wait for the crash, buy them back and get them cheaper and therefore get more of them, or you could continue to hold the stock and you can buy stock insurance in the form of what we call a put. And so even though I'm still holding this stock, the insurance, it stops the bleeding for me. And if I have full coverage insurance, it actually makes it where I profit off of the recessionary cycle. Like when the
Yep.
cycle is going down, I could profit off of that. And if it continued down from here, we could profit even more. And so that's what we're telling you. Blair, do we have any idea of where this might go to?
Well, that's the thing. I mean, and Dave and I were discussing this a little bit beforehand. Where did my chart go here? Um, again, we don't guess. So how do we do this? Like how do you approach a question like that? Because
Sounds like
no
prediction, right?
doubt a lot of people have that question, right? Like, okay, well, where do you think this is going to go? So what we do is we look on our chart, okay? We look at our price and we go, where were some places in the past where traders, investors, the big money went and said, hey, this is a place that I'm very much interested in this stock. It was a place, a price where they were really strong at buying or they were really strong at selling, or maybe both, right? But we can identify objectively that in the history of the market, this is a price point that was really pivotal, literally pivotal, right? You say, well, Blair, just because you identify something in the past that created a pivot, that doesn't guarantee a pivot in the future. That is true. It does not guarantee it. But those significant pivot, right, areas, those significant what we call levels. Think about a floor and a ceiling. The floor and ceiling in your house is pretty darn important, right? Well, that's true in the stock market too. There are multiple levels. It's less of a house, more of a building. Okay, those floors matter. Nobody wants to go falling through a floor. So we want to have strong ones. What's one that has held up under some weight multiple times? That's the concept that we teach you when you're learning to read, because you're going to learn to read the chart. So when I look at that here, really the next major thing, okay, I'm going to go here. I'm going to actually pull this back up here. We'll do this. All right. Everybody can see my chart. When I switch to a weekly view, Dave, so it just kind of shrinks the chart down. So now every one of these little bricks, these blocks we call candles, they are now a week, okay? We just broke through this blue line. So that one didn't work, okay? That's a significant one. We'll teach you what those are in the courses. But down here, 5,400, okay? Now 5,400, that's another 15. I'm sorry, not 15. That's another 160 points down, right?
It's a big drop.
160. Now we moved 130, 140 almost. I believe it was yesterday. Okay, at one point. So that's not outside of the realm of possibility to get down there even in a single day or a couple of days right now. Remember, Dave quoted that, right? They tend to take the stairs up, the elevator down. Fear falls faster. That's what happens in the market. Okay. So we could see 5,400. Now I'm going to go back to what we call a daily chart here where I can see, let's go to a full year of time though. I'm going to get my cushion back here on the right-hand side, like so. Okay. Down here, that's 5,410. You can see some points here that really stuck. So I would say that outside of the news creating a shift in direction, because right now we're helping our students really navigate the news, because that's the big factor here. Trump news. Technically speaking, though, 5,400, 5,410, if it continued to drop here, I would definitely have my eyes on that. Now, when I look at that, do I go, yeah, I'm going to buy at 5,400? That's what I'm going to do. No, I'm looking to see if the knife that somebody dropped hits the floor and stops bouncing around and spinning. I want it to stop. Once it stops, then I might try to pick it up. Okay. We need some wisdom to know exactly how to do that. But to your question, Dave, that's the next one that really sticks out to me here. What's important to recognize is that where we're at, we don't know if it's going to continue down that far. But based on what I see objectively on the chart, there isn't a level, isn't a floor that has been historically significant between where we are and another 150 points down. Okay. And as the market moves down, the percentages here are going to accelerate. So if we give up that ground, that's just another leg down in those scenarios I mentioned earlier. So doing nothing, which is the point of our webinar today, right? Doing nothing has to become a non-negotiable for you. Doing nothing has to be something that you're going to say, all right, been there, done that. I'm crossing that option, that choice off the list.
So, you mentioned this 50, what is it, the 50 week that we're really close to. We've broken through.
We broke it yesterday.
The
Yeah.
day's not over, right? Day's not over. We could see this thing try to get back above the 50 week, but it is so far down below it at this point that there's a very good chance that we see it go on down to 540 or 540, like you said. That's a big drop. So what does that mean? Well, what do I do? Well, that's dependent on your situation, which is why you're going to want to have a conversation with us. Make sure that you text the number. Misty shared it in the chat there. Text the number and get a plan, guys, because it's really not that complicated. In a matter of minutes, Blair was able to help you understand what retirement insurance can look like. The world will try to make it complicated because they don't want you to know this stuff. They want you to just put your prospectus in a drawer, forget about it, don't look at it for the next couple of quarters, and it'll come back up. But when they're doing that, they're stealing time and money away from you and your family. What we want to do,
Dave, go ahead. I'm sorry.
I was going to say, what we want to do is we want to empower you to know when that's happening and to understand how to keep it from happening in the future. What were you going to say, Blair?
Totally. Well, I was just going to say, everybody consider anything you've ever learned. Think of the most important things you've learned intellectually, relationally, spiritually. You know how many times I've had people be like, man, I want to connect with God more, but I just find the Bible like it's confusing, or I don't really know what's happening. We need a base knowledge to be able to navigate the Bible relationally even and let the Lord speak to us. So what am I driving at? It's not just Bible. I'm just saying anything in your life, right? The unfamiliarity of it at one point or another felt like complexity.
Yep.
Is there things in life that have complexity? Yes. Now that's a bit subjective, but there are, aren't there? But you learned amazing things that have deeply enriched your life and made it more of what you want it to look like because you engaged the unfamiliarity. And the good news is that so many of the things that feel really complex, they actually aren't as complex as we think. It's just that we
Yep.
don't know.
We
How
don't think that
complex is it
walking
to
is
stare
hard to
at the
do.
page of a book and
Yep.
read it? Well, when it's brand new, yeah, it's a little bit intimidating, but you
Mhm.
have the right support, you have the right help, and boom, you can do it. What
Just like
otherwise
you
feels
had.
like a fairly complex thing, this is easier than that.
Mhm.
And we give you the support to learn how to do it. So don't count yourself out. Don't give up on yourself because you feel like, there's some complexity or this language is a little bit different. Yeah, it is a little bit different, but it's only unfamiliar. As you spend time in the right environment, growth will come naturally.
So just like you had to have someone teach you how to speak, right? You watched mom or dad or a sibling form the words with their mouths as you were little. That was weird and complex to you at one point. And now it's second nature. You had to hold on to somebody's hand while you learned to walk. You had to have somebody in the passenger seat, side seat when you learned to drive. And these are things that just become natural to us. Understanding what to do with your money should be no different. It should be a second nature thing for you. It does not have to be complicated. It doesn't have to be scary. And it doesn't have to cost you as much as it's costing you not to know right now. So let's make sure that we get you a plan. Text the number that Misty put in the chat, and we'll start empowering you to take control of your financial future. Guys, thanks for being a part of this webinar. I hope this was helpful for you. I hope it gives you a little bit more peace to have some understanding of what is happening, why it's happening, and what you can do to prepare in case it keeps happening. And Blair, thanks for being on with us and showing us all the little golden nuggets you did about the stock market and about these things called puts. Really
Yeah.
appreciate you being on here. I know
Yeah.
that
I
you
mean,
can't wait to get people started and help them out.
totally. I would say to everybody on here, congratulations for being here. Because I really mean what I said. There should be 250 people on here. There should be 2,000 people on here because they are out there asking the questions that y'all are asking. You guys just actually did something about it, and now you have something you didn't have,
Yep.
right? So let's learn to implement it, get yourself a plan, but good for you. Thanks, Dave.
All right. Y'all take care. Have a great day. We'll see you in the market.
See you guys.